So what does the accounting cycle look like in an accounting information system? The accounting cycle is all about transactions, where we give something and we get something in return. It's called a give-get relationship. Really, when all these transactions are recorded, think about a store. A store is going to record each transaction by scanning items and then totaling them up for the customers. A customer never sees debits or credits, they just see the total amount of the bill, and then the system transforms that into revenues and accounts receivable and other transactions. So here's a shocker. Debits and credits do not exist. They are simply transformed transactions to help us understand what's going on. However, these transactions do exist. So let's look at this a little bit more in depth. So here I've got 6 different processes within a business. So you've got the finance cycle where you're trying to raise money, purchasing where you use that money to buy stuff, payroll, you pay for people's time so they can perform action, convert stuff, and so forth. Production is where you're going to produce things from raw materials into finished goods. Sales are where you transfer them to customers and you collect cash from customers. And then you have the reporting where you're going to create the financial reports and the summary details that you share with your stakeholders. In the finance cycle, we are going to interact with creditors and shareholders to raise cash. So we need cash from somewhere. They give us money, and in exchange, we give them money back in the form of interest or dividends or other payments. So transactions that we'll see here, we're going to see a cash receipt. Sometimes we call this additional paid-in capital in our equity statement. We have cash disbursements, which include payments out, including dividends and interest and so forth. We're going to see dividend transactions, as well as the issuance of shares. These are transactions we would expect to see in the finance cycle. For purchasing, we're going to take that cash that we received, and we are now going to exchange that for goods. These could be raw materials, they could be office supplies, they could be any number of things that we're spending money on. We are going to give cash and get items. So some documents and transactions you'll see here. The first one is a purchase order, where we're basically requesting stuff from a supplier, and is essentially a contract that we're making with them. We have a goods receipt. This is when the goods actually appear in our warehouse. We can track what we have received and what we are still waiting for. We have an invoice receipt. This is when they send us a bill, and we now have to pay that. And then we have, again, a cash disbursement when we pay cash out to our suppliers. In payroll, we're taking that same money that we've raised, and we are now going to spend it on time, our employees' resources here. What we do here is we are going to look at payroll. So this is going to involve some transactions such as updating payroll. We have to record time on timesheets. So our employees are going to clock in and clock out. There will probably be an approval process with that as well. Then we are going to prepare payroll. That means writing all of the checks, making sure there's money in the bank account to pay for those checks and so forth. Then we are going to disperse the payment. So we're going to send checks out to our employees. And there will also be a tax payment associated with that. We're also going to send cash to the legal authority over the workers where we work. Production involves converting things. So we are going to take both the stuff that we bought in the purchasing cycle and the time that we acquired and that we're paying for with our human resources and payroll cycle, and we are going to use those to generate finished products that we can then sell to customers. In this cycle, we're going to have transactions that relate to the design of the material. And the design would include something like a bill of materials. Bill of materials is essentially a part list, so all of the different components that go into that finished good. We're going to look at production scheduling, or how we move the different processes through our warehouse. We have conversion, where we're going to record the direct materials, the direct labor, and the manufacturing overhead assigned to the different projects. So these would be those job costing sheets that you learned about in your managerial accounting course. And then we have cost allocation, where we assign costs to different areas, different departments, processes, depending on the cost scheme that we've developed for our company. For the sales cycle, we're going to take that finished product, And we are now going to convert it to cash by selling it to a customer who's going to give us cash in exchange. So this is going to include a sales order, where we receive a request. Essentially, it's the same thing as a purchase order that another company is sending us. We have the shipping process, which involves steps of going to the warehouse. We're going to pick things off the shelves. We're going to pack them in a box, and then we're going to deliver the goods. We're going to have the billing portion, where we send an invoice to those customers saying, hey, we're glad you like our stuff. Now please pay us. And then finally, we'll have our cash receipt. So the purchasing cycle and the sales cycle are mirror reflections of each other, depending on whether we are the customer buying stuff or whether we are the seller selling stuff to the customers. Finally, when we're preparing our financial reports, there are a couple things we have to do. We're basically taking all of the details from these different transactions and we're consolidating them into a summary of the transaction activity. We are going to update the general ledger. We're going to record adjusting entries and accruals. So these would be prepayments and use of prepaid items, recording unearned revenue and so forth. We're going to prepare financial statements, including the income statement, the balance sheet, the statement of cash flows, and so forth. And then in addition to this, we are going to prepare management reports, which would be things like your flexible budget from your managerial accounting course, or looking at performance of specific products or divisions or so forth, trying to evaluate how efficiently you're running your operations. So throughout the semester, we are going to revisit these processes. We're going to see what this looks like in a computerized system. We're going to see how companies deal with this and consolidate it throughout different things. Are there any terms in this list that are unfamiliar to you? If they are, don't worry, we're going to cover them, but you may want to take a moment and look up the definition and look up some examples on the internet, because this will help you understand some of the terminology that we're going to come across. Remember, in accounting systems, there's a whole new set of vocabulary, a whole new set of forms and processes and transactions that we're going to be working with. So you want to make sure you've got a good handle on this from the get-go. And that concludes this first lecture series.